Everyone, welcome back. Today we're looking at Watches of Switzerland. Now, the shares of Watches of Switzerland recently plunged. Boss of Rolls-Royce sellers say that they underestimated luxury slump after 30% drop following volatile trading. The boss of the biggest seller of Rolexes in the UK admitted that he had underestimated a slowdown in luxury spending after a profit warning sent to group's shares down more than 30%. This was quite recent. It's a few weeks now, but this was just around the middle of January. And it was really unexpected. So, Watches of Switzerland, which sells high-end timepieces including Rolex, Audemars Piguet, Cartier, it is said it had experienced a volatile trading performance in the run-up to and beyond Christmas. Chief Executive Brian Duffer said that consumers had focused their festive spending on other areas such as fashion, beauty, hospitality, and travel. Added he was disappointed with the trend. The retailer is the latest in a string of luxury group to flag a slump in high-end consumer spending following a pandemic-era boom. And this is true. This is true. Since 2019, 2020, the watch market have gained significant value for some reason, especially the resale watch market is gained significant value, the luxury timepiece market. And don't get me wrong, it's always been valuable, but recently it has gained extraordinary amount of value. And I think just like anything that goes up, it must come down at some point. It wouldn't have lasted forever. But what I can say is that this is now still even more so an undervalued company. I've done the numbers. And even at the valuation it was prior to the shares falling over 30%, this company was undervalued. And now that it's down 30%, it's even more undervalued, in my opinion. Based on the market cap, take into consideration the revenue and the growing profit, it is undervalued. Now, to say the least, the profit will be affected, especially in the latter parts of 2023. But even in early parts of 2023, they were doing extraordinarily well in terms of valuation and revenue. It's going to be interesting to see what happens from here, but it's quite normal for this to happen sometimes. Consumer behavior do change, especially when the market has gained so much momentum since 2020. The market has gained a lot of momentum. It was guaranteed to had a huge reflection at some point. It was guaranteed that this would happen at some point. And to be honest, I'd rather it happen now because I expected it. I'm surprised that they didn't expect it. But it's not just this company that was affected. There's other companies that have been affected as well, especially after a time such as Christmas. But I do think it's a little bit blown out of proportion. I do think people are over exaggerating, just like they always do. They're selling more than they have to. However, their loss is my win. Now, Duffer said the company, which is the UK's biggest seller of Rolex, Omega, Cartier, Tag Heuer, and Breflin watches, had received a different mix of Rolex watches from Swiss manufacturer than normal, reducing its average selling price. Hold on. They'd received a different mix of Rolexes from the Swiss manufacturer. That's interesting. So Rolex sent the company predominantly steel-based watches rather than a greater number of more expensive ones made of steel and gold. While the market price was going up, Rolex was actually sending less valuable watches in terms of material. That's interesting. And I do like this company, so I do pay attention to the smaller detail. So they produce more steel and less of the precious metal. But it would seem like if Rolex is trying to sell those watches at similar value while reducing the cost through the material, Rolex is trying to make more money in some very interesting ways. And that's quite normal for a company. They have to find new ways to make money. I wouldn't think Rolex would go that far because they've been doing extremely well. But maybe they want to do better. Let me tell you how well they've been doing. They just bought one of the largest retailers in the world of Rolex watches. I made a video on this as well. I think it was Buccieri. They bought that Rolex. They bought that watch dealer. That was a huge chess move by Rolex. I respect that, but it's a pity I can't invest in Rolex. It's really a pity that I can't invest in Rolex. So Duffer added that there was no change in the overall number of Rolex watches it had received. And he said the shift reflected more conservative approach from watchmakers amid decreased consumer confidence. If consumers are buying less watches, why would you then reduce the material value? And if they do go down, even more in share price, I win. I get to buy a valuable company at a cheaper price, a company that's not going anywhere, a company that will recover eventually. They have recovered before, they will recover again. This is the luxury market. There's always a fall off in consumer purchasing behavior. Rich people are not rich all seasons. Trust me. That should be a quote. Quote by me. Rich people are not rich all seasons. Trust me. And who are the main buyers of these items? Wealthy people, rich people, medium income householders. So people are doing better than average, basically. That's what I mean to say. Middle class. That's it. Middle class and upper class. So it comes after Watches of Switzerland was buffeted last year when Rolex acquired rival watch retailer Bouchetti. I did say this earlier in the video, raising fears that Rolex could sell more of its timepieces directly to consumers. Directly to consumers, which means if Rolex sells their most valuable items within their own retail, which is now Bouchetti because they bought that company, Rolex makes more money. Because guess what? When Rolex sends watches to Watches of Switzerland, Watches of Switzerland gets a percentage. Rolex gets a percentage. Everyone gets a percentage. That's the market that you're in. But you see, when you sell the watches directly through your own boutiques, through your own hands, through your own retail store, you own 100% of that profit. Could this be what Rolex was trying to do? So maybe they weren't lowering the value of their watches, but maybe they were keeping their most valuable assets and sending the least valuable to other retailers. This is a new thing for Rolex. I don't think they've ever owned a retailer before. This is a new step for Rolex. And this decision might not be the smartest decision. You can't just cut out your retailers who've been selling your watches for a very long time. You can't just cut them out of the picture and start sending them less valuable items. That's bad for the Rolex business and that's bad for their business. Yes, you own your own retailer, but you're still relying on others. I have a feeling that if that's the strategy that Rolex is using, it won't last for very long. They'll realize that there's value to having partnerships with others and valuing them as much as you used to at one point. Now, revenue for the company's financial is now expected to be between 1.53 billion and 1.55 billion, down from the previous 1.65 billion to 1.7 billion. Its operating margin, which previously expected to be in lines with last year's 10 to 7%, is now estimated to be between 8 to 7 to 8 to 9%. The downgrade implies an adjusted annual earnings before interest and tax. That's the EBITDA, I believe. That's the EBITDA. This is of range of 133 million to 138 million compared to 176 million to 182 million previously. Okay, so what we're seeing here is a 50 million difference. This is what I mean when I say this was a huge. Investors panicked too much. They overestimated, they underestimated the company, if anything. In terms of earnings before interest and tax, this is not so large. It is a problem. So if they make $1 billion in revenue, the profit is usually around 8 to 10, maybe 8 to 10%. That would be good for some companies. 11% would be amazing. For some companies, they're barely getting 5% in terms of profit. But for companies like this, it's a huge deal when something like this happens. For me, I'm not panicking. This is a $50 million difference. It doesn't make sense that the share price has fallen 30%. So what that tells me is that there's either more to this story or people are just panicking. And people love to panic. And when people panic, I win. When people panic, as corny as that might sound, when people panic is the best time to buy because it's the cheapest the share price will probably ever be. The share price haven't been this cheap since early 2021. The share price have not been this cheap since early 2021. In fact, late 2020. I'm not panicking. Listen, the company is still looking to generate over 1.5 billion in revenue. What's the valuation of the company currently? Market cap, 916 million. The company is making more money than it's valued. Not in profit, but in revenue, they're making more money than they're valued. I take no joy in sharing this information with anyone that I've found one of the best undervalued company to invest in. I take no joy in sharing this with people because this is not financial advice. It's just my opinion. So obvious that it's undervalued. That's all I have to say, really. Now, in terms of financials, these are some of the numbers. Back in 2020, in total revenue, it was 810 million. 2021, 905 million. 2022, they cracked 1.238 billion. And in 2023, 1.5 billion. The company is growing at an exponential rate, but this is what I meant. The pandemic spending was huge because there was a huge influx in capital. There was a huge influx in credit for a lot of individuals. And for a lot of markets, prices were good. In terms of gross profit, you're looking at 2023 compared to 2022. 2023, they're still beating 2022 in terms of gross profit, despite the downwind in terms of consumer purchasing behaviors. The company is still doing fantastic in terms of growth. Just look how much they've grown since 2020. Now, like I said, 2020, 2021, 2022, it's all a little bit unrealistic, but when the market does fall off, it doesn't return exactly to where it was previously. So it's not going to return to 2019 income. It's going to be reduced by quite a bit, but it will stabilize. So dropping 30% in share price starting to make more sense because it's going to stabilize around that area. And from that area, that's the more realistic what people see in the true value of the company. And it's still undervalued for me. But from there, it will climb up. This is quite natural. Anyone who's been a manager of a company, they know whenever you go through great financial rewards, there is a storm ahead, and it's going to drop your value quite a lot. The income, the purchasing power, everything is going to drop significantly. But if you've gained 200% over the last 2 years, it's not going to drop 200% suddenly. It's probably going to drop 50% at the most. You still gain 150% in those 3 to 4 years period. For the investment market, all they see is the 50% that you've lost. They don't think back and reflect, but this company has grown so much. Take into consideration everything. This company is doing fantastic, which is why I think it's heavily undervalued. So I hope my analysis made more sense. There's a lot of great data right here on Yahoo Finance. I recommend this to anyone who likes the stock market, views the stock market, invests in the stock market. It's not financial advice, but it gives you great information because it's all here. Let's take a look at Watches of Switzerland in a little bit more detail. So, for one, this company has been profitable since 2020 and perhaps even longer. So, could we look at 10 years? Okay, so I'd say mid 2019, but early 2019, you can see they were negative in free cash flow. Early 2018, they were also negative in free cash flow, but they kind of recover in late 2018 to early 2019. It's mid 2019 that they were struggling once again. Since then, just before the pandemic, they were already on the road to recovery. But you can see during the pandemic is when they made the majority of money. And since then, in terms of free cash flow has fallen by some percentage. And this is what I mean. It doesn't fall by 200%. If you've gained 200% already, it will fall like 50%, but it will stabilize. I believe what we're seeing is a stabilization period. That's why from 2022 to late 2022, early 2022, late 2022, early 2023, mid 2023, you can see the prices stabilize. And if anything, they're increasing. But the increases are getting smaller and smaller. That makes a lot more sense. 2020, 2020, these are all through 2022. But you can see the jumps are getting smaller and smaller. I believe that's a stabilization, but the earnings before interest, tax, that's been doing fantastic. And this is something that investors always pay attention to. And that's been doing well since 2018, probably even a lot longer than that. Long term, I'm not worried about this company. I'm really not. But I wanted to make a video nevertheless, just talking about it, to be honest. There's some other stuff that we can go through. But one of the most important part is whether or not the share price, one of the most important part that I'll end on is whether or not the shares outstanding has been reducing or has it been increasing. So let's take a look. For as long as we can think, it's somewhat stable. It's a little bit up and down, but it's, especially recently since 2020, it's minuscule, which is good because we don't want to see them increase in share price. We don't want to see them increasing the share outstanding too much because then it devalues your money. It depreciates the stock itself. But that's it for today's video. So I hope you enjoyed it. Thank you for watching and I'll see you in the next one. Peace.